Welcome back to the Money Loop. Let me start with a question that sounds simple, but actually sits at the core of modern investing. If you have two portfolios that both return 10% on average over time, would you consider them equally good? Most people instinctively say yes, same return, same outcome. But in finance, that answer is incomplete, and in many cases, it's misleading. Because returns only tell you what happened on average, they do not tell you how it felt to get there. And that difference comes down to something called variance, the hidden force that determines whether your investment journey feels smooth or completely chaotic. Let's slow this down and make it intuitive. Portfolio variance is simply a way of measuring how much returns fluctuate around their average over time. In other words, it tells you whether your returns are stable or all over the place. Now imagine two portfolios. Portfolio A earns returns like this over four periods: 10%, 10%, 10%, and 10%. Portfolio B also averages around 10%, but behaves very differently. It gains 30% first year, then loses 10% next year, then gains 25% next year, and then the last year loses 5%. Now, if you look at the average, they might seem similar, but your experience as an investor would be completely different. Portfolio A feels calm, predictable, almost like a steady machine that just quietly compounds. Portfolio B, on the other hand, feels unstable. One year you feel brilliant, the next you feel like everything is falling apart. That constant emotional shift, that uncertainty, is what variance captures. So when we talk about variance, we aren't really talking about consistency versus chaos in returns. And that distinction matters far more than most beginners realize. Here's something that is rarely emphasized enough. As an investor, you do not actually experience average returns. You experience the path those returns take. And that path completely changes how you behave. Even if a portfolio performs well over long periods, high variance can lead to very real consequences. When returns swing aggressively, investors tend to panic during downturns and sell too early, chase performance after big upswings, lose confidence in perfectly valid strategy, or even abandon long term plans right at the worst possible time. So, variance is not just a statistical detail, it directly influences human behavior. And in investing, behavior is often the deciding factor between success and failure. Because even a great portfolio strategy becomes useless if you can't stick to it. So, in many ways, variance is not just about risk in the market, it's about risk in decision making. Now, let's build intuition for where variance actually comes from in a portfolio. A portfolio is made up of multiple assets, and each one has its own level of risk or volatility. And the key insight is this: portfolio risk is not just the sum of individual risks, it depends heavily on how those assets move together. This relationship is called by something called correlation. Here's the simplest way to think about it. If two assets always move in the same direction, up together and down together, then combining them doesn't really reduce risk. But if two assets move differently, or better yet, in opposite directions, then something interesting happens. When one asset is down, the other one moves up. And that interaction smooths out the overall portfolio experience. That is the foundation of diversification. Diversification is not about owning more assets, it's about owning assets that don't behave the same way at the same time. And that is what reduces variance at the portfolio level. Now let's briefly introduce the structure of the portfolio variance formula, not to memorize it, but to understand what actually derives it. At a high level, portfolio variance is built from three components. First, you have the risk of asset A, weighted how much of it you actually hold. Then you have the risk of asset B, also weighted by its allocation. And then there's a third term, the interaction term, which depends on both assets' volatility and their correlation. So in simple terms, portfolio variance is equal to the risk you bring from asset A plus the risk from asset B plus how those two risks interact with each other. That interaction term is the most important part because it determines whether risks reinforce each other or cancel each other out. If correlation is high, the risks amplify. If correlation is low, though, the risks dampen each other. So while the formula looks technical, the intuition is surprisingly simple. It's all about how much your assets agree on what the market is doing. Let's bring this into the real world, however. Think about a simple portfolio with two major asset classes: stocks and bonds. Stocks tend to be high growth but also very volatile. They can rise sharply, but they can also fall quickly and dramatically. Bonds, on the other hand, are usually much more stable and less reactive to market shocks. Now, here's where diversification becomes powerful. These two assets do not always move together. In fact, in many market environments, they often move differently, sometimes even in opposite directions. So, when stocks experience a sharp decline, bonds may hold their value or even increase. And when bonds are flat or slow, stocks may be driving growth. This offsetting behavior smooths out the overall path of the portfolio. Even if both assets are individually risky in isolation, together they can create a much more stable combined experience. And that stability matters more than most people think, because smoother returns mean fewer emotional mistakes, less panic during downturns, less overconfidence during rallies, and ultimately more consistent long term compounding. So, diversification is not just a technical concept, but it is a practical tool for protecting investors from themselves as much as from the market. So let's bring it all together. Variance is not just a formula from textbooks or academic papers. It is a way of describing how your wealth behaves over time, not just where it ends up. And once you understand that, you start to see investing differently. Because the goal is not just to maximize returns, it is to control the journey those returns take. And in most real world cases, the investors who succeed are not the ones who take the most risks, but the ones who design portfolios that they can actually live with. Because in the long run, the biggest risk in investing is not volatility in the markets, it's volatility in your own decisions. That's the real meaning behind portfolio variance. And that's what we explore here at the Money Loop.